Hello and welcome. I'm Matt Fifield. I'm the managing partner of Pacific Road Capital. So originally, when Andrew on the Minds of Money team asked me if I could address the topic of does ESG still matter to financiers, shareholders, and investors in the post-COVID-19 world, I thought, geez, what a softball. Yes, is the short answer. It does. But then looking at that a little bit more deeply, obviously stress levels are up. People are cutting discretionary expenditures, and the question and issues around do pursuing high standards of ESG practice and implementation cost more was at hand. So, look, we have 10 minutes together, and I thought I would cover a few different things. One, a very brief look on what the world looks like today in terms of setting context for this discussion. Second is really a point for the miners out there why you should care about ESG and how that relates to competing for capital and the intention of investors and lenders and other capital sources. Then I'd like to close really around what at Pacific Road our perspective is on ESG and a couple logical steps to take. Just a brief word for those of you that don't know me or my firm. Pacific Road Capital is a specialist mining investor. We've run two funds with just shy of $800 million in commitments. We're normally one of the largest shareholders or the largest shareholder in a public company or an outright owner of an asset. And so we're very tightly integrated with management teams and boards, often with board representation. And that really draws into focus how businesses operate, how they identify and manage their material risks, and ultimately how they disclose them. So what's the world look like today? The chart in front of you, this is total market capitalization indexed to the end of last year. And I think everybody that's listening in probably has a good sense of how this is. But just to repeat, gold is the gold bars, and blue is effectively everything else. And that's really reflective from the where the world is right now around a two-speed market. What you saw in the sell-off is everything sold off, gold a little bit less than the rest of the world. And then with the strong macro conditions and the uncertainty, fears of both inflation and deflation, gold has had a very strong run. But with everything else, the tide went out, as it were, and kind of has stayed out. And to put that into historical context, values in the non-gold world in particular are remaining around trough levels. So at Pacific Road, we're fundamental bottoms up guys, and we think about absolute value, replacement value, and one metric that we look at is enterprise values to both debt and equity against the tangible book value. It's not perfect. There's a lot of accounting that goes around tangible book value and how that relates to replacement value. But let's just say that it's kind of one of the best measures that we've found. And over time, what you can see from 2000 to today, if you close your eyes and look at that dark blue line, which is the median, you can see that values have generally been decreasing against enterprise value against tangible book value over time. And today, with the increased uncertainty in the world, the non-gold sector remains at very low absolute historic levels. So going back to it, gold's had a nice run in the recent past, and non-gold is struggling and on kind of a declining trend of valuation in general, and today towards the bottom of that. So let's turn back to ESG. What does that mean? Does ESG matter to you? Does ESG matter to us investors? Yeah, I mean, the answer is yes, it does. There's two aspects to it. The first is when you think about that declining value, in some ways, that's a signal from the market that they're not willing to pay as much for mining companies, and we'll go into it in a second. But there are a lot of different reasons that is, and part of that is along the surprises and business challenges that, if unmitigated in mining, are probably unlike many other sectors. The second is that today, in a post-COVID world, the competition for investor dollars has never been higher. So if you step outside of our mining world and you think about all of the opportunity that an investor has to put money to work and to try to make a return, there are a lot of different sectors that now today represent compelling investment theses and return scenarios that maybe weren't as true. That statement may not have been as true 12 to 18 months ago. So that just means that the mining sector needs to compete harder. The competition is more fierce. And so eliminating some of the risks and negative thought process around what could go wrong with my investment um, is something that you actually need to take to heart when you're trying to raise capital or attract new investors and partners to your platform. The second is that in this world of increased risk and uncertainty, all the stakeholders around you, your employees, their families, their communities, the regulators, your customers, other shareholders, other industry participants, they need strong partners. And this is one of these times where in a crisis, everybody remembers how you act. So being consistent and being systematic and showing that systematic strength, it's actually a time when this is very, very important. So right now, it's important to stakeholders, it's important for the future of your business, and it's important to attract investors. So how do investors frame thinking about ESG? Well, primarily, most people think about it in terms of headline risk reduction, and there have been countless headline risks where you can wake up and see the value of your investment diminish overnight. So identifying, managing, and talking about how you giving people the confidence that you're both identifying and managing your material risks is really important, and that is tantamount to ESG. The second, and something that we've seen at Pacific Road again and again, is that in fact having strong ESG systems, not just ethoses, but also systems, the systematic nature of it allows you to access capital that you wouldn't have otherwise. It basically opens up liquidity amongst investors and potential trade buyers and strategic investors. And it allows you to attract the right people to your business. And while it starts with rocks, mining businesses are built on people talent as well. So that's all very nebulous. Let's get granular. What are we focused on as mining investors around ESG factors? Well, there are 8 principal areas that we've identified that can present material risks that can really set an investment off track. And they're here on the screen in front of you. All mining companies deal with anti-corruption and anti-slavery laws. It is actually just a part of the legal framework. And so whether you are being proactive in addressing and managing these risks or reactive can actually matter quite a bit. Because I would say that those are 2 areas that if you are not reactive, if something goes wrong and even there's an allegation true or not, you're deemed guilty, and that can have huge negative impact on your stock price, on the management and attention ability to run your business. That area in yellow in the middle, tailings, air, water, power sources, carbon, occupational health and safety, that's what I think a lot of people particularly in the mid cap and junior mining sector operators, they say, man, we're working with that every single day, and you are. But let's get in a moment to if you're managing it proactively or reactively, and if you're telling people about it. And then finally, other areas that we've seen certainly are Indigenous people, community relations, and diversity as being places where companies can go tremendously off track. And so when you're thinking about risk mitigation, we look at those 8 factors. It's true that for any individual mining company, the materiality of any one of those may be very different. But those, I guess, are the 8 that we've been focused on materially for the last 4 years. So when we talk about, or when I talk about ESG, what I'm talking about is building in systems and not just the ethos around that, and ultimately the way that you deal with managing those risks systematically can become very compelling stories about what you're doing right. And when you have those compelling stories, one of the questions is, are you telling anybody about it? And it turns out that larger companies do, and they usually do that by putting it on their webpage, featuring it on their webpage, and by issuing transparency disclosure reports. And smaller companies don't. And my personal experience has been that smaller companies are typically much more rock focused, and much less business focused. And by that I mean much less about the how you're running your company. So every 6 months we do a survey.